Hello, friends. It's Friday, March 1st. It's about noon 30 on the West Coast of the United States. In this video, I'll be talking about gold. If you see the mess in the background, well, I'm unpacking boxes yesterday and today. And so, I'll get settled in eventually. Let me share my screen here and we'll get going. Again, a gold breakout. Notice the title of this video, gold breakout. I believe that we have a breakout occurring and that breakout is significant. I was looking at this chart early this morning um, before this big move happened, and I was already excited about this chart. And I went off and I was doing some other stuff, unpacking boxes, and came back and saw this. I'm like, holy cow, what's going on? And so I believe that this is what the market is reacting to. It's the talking heads at the Fed hinting at the idea that we are headed back into quantitative easing. Now, not surprising that at least initially, they're not going to come right out and admit, yeah, we're going back to quantitative easing. They'll come up with some fancy ass name for it. Who knows what they'll call it, reverse twist. Who knows what the heck does that mean? But anyway, I believe that at some point, the Fed's going to come right out with openly acknowledged quantitative easing. Basically, they're going to say, hey, we're firing up the printing presses. And in my opinion, in this round of quantitative easing, the amount of fiat currency they are going to run off the printing presses is in the 10 to 12 trillion with T, 10 to 12 trillion dollars worth of fiat currency. And of course, that's going to feed into inflation and which means that we pay more interest on the outstanding debt and then we have to print more money. Anyway, in my opinion, we're definitely in a downward spiral, doom loop, call it what you will. Not a good situation to be in, but that's where we're at. I believe in the big picture, the biggest picture, we are at the end of the Keynesian experiment with fiat currencies. That basically the world is done with fiat currencies, and it's going to take a while. It's not going to happen overnight, but basically, as fiat currencies continue their death march. We will see signs. We'll see signs of that occurring. And so anyway, I suspect that this is what the gold market is reacting today. It's talking head at the Fed, hinting at QE. This is some of the stuff he said. Like to see the Fed's MBS holdings go to zero. Well, if you're paying attention to what's going on in the real estate markets right now, commercial real estate in particular, I wouldn't want to be holding any debt that was tied to real estate at this point either. And no different, you or I or the central bank, when real estate is tanking, you don't want to be involved in real estate. The roof over your head, obviously that's a different, topic, but certainly real estate as an investment, now's not the time. Not the time, without actually calling it QE. And so, that just makes sense from political reasons. Don't scare the masses. Don't wake up the masses. Don't come right out and tell the public, hey, we're a banana republic and we're going to start running the printing presses. What do you think? I mean, that's not a good marketing campaign. And so they're not going to, at least initially, come right out and say, hey, we're going back to open QE. I think ultimately we will get there. They will be forced to acknowledge that we're back at a point where they have to, and of course, that will be the sales pitch. We have to go back to openly acknowledged quantitative easing because we've got 10 to 12 trillion dollars worth of debt instruments that we have to sell. And I've said this before, but just quickly. So we've got, last time I saw the number, it was 7.6 trillion dollars worth of US debt instruments that have to be rolled over in the next 10 months or so. $7.6 trillion worth of debt instruments that have to be rolled over in the next 10 months. There is no money to pay off those instruments, so they have no choice other than rolling them over, which means somehow somebody's got to come up with $7.6 trillion. There aren't organic buyers for that much debt. And keep in mind as well as background for this conversation, the US is not the only entity trying to sell debt instruments. We've got US corporations with, I forget the exact number, 700 billion, 900 billion, pushing up into $1 trillion worth of new debt instruments that US corporations, international corporations really, intend to sell this year. And then we've got deficit spending from the US government. That's another another $3 to $5 trillion that will have to be raised somehow. They don't have income to cover that deficit spending. So again, they have to go to the debt markets, issue new debt to cover their deficit spending. So that's US, which that was a tangent, and I apologize. I was talking about how in the background, there are more entities than just the United States trying to issue debt. EU's trying to issue debt. Individual countries are trying to issue debt. Lots of people, entities trying to issue debt in the next 10 to 12 months. And so it's not, we can't just focus on the United States and its need to sell 10 to 12 trillion dollars worth of debt instruments because they aren't operating in a vacuum. There are other people also issuing new debt. So I think that was all I had in this particular article highlighted, but full circle back to where I started. I suspect that this is what the gold market and precious metals, silver's rising strongly as well. I suspect that's what they are reacting to short term today. Now, people who are paying attention might also notice the rising geopolitical situation. Putin did a 2.5-hour address to his nation yesterday. And basically, he's emphasizing in very clear terms to the West at this point, if you put boots on the ground in Ukraine, it ain't going to be pretty. And he's not pulling any punches on his speaking to that point. So, and I'm not going to use the language, but anyway, that's a bad road for us to go down to. But I'm talking about all kinds of stuff other than the charts. Let's focus on the charts. So when I looked at this chart this morning, there were several things that I noticed. First of all, for the last 4, 5, 6 trading sessions, gold's been bumping against this lower median line. There's an upward bias there, but basically pushing against resistance. But notice that it was pushing against resistance and not dropping lower, not doing a correction, not doing a pullback, basically consolidating, gathering energy. So when we see a vehicle, gold, whatever, when we see it moving sideways, it's basically gathering energy for its next move. In this case, obviously, the next move was upward. And so anyway, gold has been gathering energy for, about 2 calendar weeks. And now we're seeing the breakout. Actually, it started yesterday. We got a pretty nice looking candle pushed up into this resistance zone and then pulled back from that level. Now today's pushed up into and through impulsively and decisively, has pushed through that entire resistance zone. Very, very bullish action. We've got the moving averages in bullish alignment. 20 has just broken above the 50, 50 clearly above the 200. So bullish alignment there. MACD in bull mode on a buy signal. Very nice action here. And again, on MACD, we have to acknowledge that this price action is occurring from an oversold level. Gold has been very oversold. And so on this new breakout, it's occurring from an oversold level. Gold has lots of room to run to the upside before it becomes overbought, certainly in the daily time frame. Energy based on stochastics, very elevated. So lots of energy for gold to make an upside move. Let's see, I made a list. And again, I made this list. I was making notes for my next video before gold had done its big move today. And so these were the notes that I had made. Well, this I added this after the big move. I believe what we are seeing, it's an impulsive breakout from an oversold level, $2,000 floor. So if we look at this chart, we can see, so here's push up into 2000, pull back, test 2000, pop above, test 2000 as support, pop, 2000 as support, pop, 2000 as support, pop. And I don't think that we're going to test 2000 again. I mean, this looks, this is, I may be premature in saying this, but based on the strength of this move today, we may never see gold at 2000 again, just saying. Let's see, MACD bull mode, lots of room to rise, energy elevated, bullish alignment, price target. So I believe that our current price target in the daily time frame is the previous all-time high, which is 2146, and then the median line of this pitchfork. So let's look at that. So currently this is a shift pitchfork based on the 3 pivot points we see here, and there's the median line. So I believe that this median line is the current target, and then we have this all-time high, 2146. And so I suspect that somewhere in here, coincident with the median line and the all-time high, that's gold's next target in this time frame. So, and again, it's just very nice looking chart. I was excited about this chart before this move occurred. So let's see what else we got. Gold in the weekly. Again, big move. That's from today. MACD somewhat overbought already. Got a little bit of room to move to the upside before bumping into this level from the prior peaks. We could, if we wanted to, we could do that and then say that MACD has even more room to run to the upside. Pick your poison. Energy elevated and rising strongly. That's about it in the weekly. I skipped over the monthly. Currently in the monthly gold chart, we're targeting, it's I think it's about 2,300. I don't remember offhand, but in the quarterly chart, I was looking at that. Primarily, I was looking at these longer term charts. When I become disheartened in the price action in the precious metals, It's just looking at the long-term charts, we remove that short-term volatility, and it makes it easier to see the big picture. And so that's why I was looking at the quarterly chart. We can see based on MACD, we're in bull mode on a buy signal, lots of room to run before we become overbought. Energy clearly elevated in this time frame. This was the exciting chart. And so this morning, it was the first time I had looked at gold on 6-month price bars. So each of these price bars represents 6 months in time. And notice that this is a cup and handle pattern. And the way to find a target for a cup and handle pattern is that you draw a line from the neckline, the top of the cup here, down to the bottom of the cup, bottom of the price action. I chose the bottom of the price action because it's more conservative. I like to be conservative in my technical analysis, projecting potential price targets. And so then we duplicate that line and put it above the neckline. Well, doing that gives us a target at 2,800. And so what I would suggest to you is that gold is currently targeting $2,800 in the big picture. This, again, 6-month price bars. Notice as well as, supporting evidence to support that premise. We've got this neckline, the top of the cup. Well, in the last 6 months, gold has clearly broken above that neckline and appears to be pushing higher from that level. Certainly, that's we've spent 6 full months above that breakout level, above the neckline or the top of the cup. And now in the current 6 months, it appears that price is moving higher from that level. Now, we do have the upper median line of this shift pitchfork as a resistance level. And we can see that certainly we've got 1, 2 times where gold has tested that level as resistance and been rejected. The test has failed. We could argue as well that there was a third test, didn't quite reach the upper median line before it pulled back. So we will have to keep that in mind. We have a resistance level that is overhead. It's, what is that, 2180, somewhere in there, 2190. And so maybe we'll see gold react at that level, round number at 2200. We'll see MACD in bull mode, got a little bit of got a little bit of room to run before it runs into this prior high. I got the hiccups this morning. Energy very elevated. So lots of energy to continue this move to the upside. So anyway, just real nice action in gold across all time frames. And so, nice action. I'm going to go off on a little bit of a tangent here. So I try to focus on the big picture. And in my mind, big picture says interest rates are headed higher. Fiat currencies are in their death throes. Basically, again, end of the Keynesian experiment in fiat currencies. We'll have to see what comes next. And so we can focus on the big picture and deploy our investable funds appropriately for the big picture, or we can focus on the daily, the daily machinations, the bullshit that the talking heads, the BLS and their cooked up numbers. It's where do you want to focus? Big picture, or do you want to be down in the weeds with the the rhetoric, the just hot air, and it's bullshit. You know, that the Fed's going to pivot. Not only are they going to pivot, we're going to get six times the Fed's going to lower interest rates in 2024. That was how we came into the start of 2024. Now we're at, instead of first rate cut in March, I'm seeing people talk about, well, maybe they'll cut in June. And we've gone from 6 expected rate cuts to down. Now I think we're down to 3. Well, let me tell you again, in my mind, my big picture is Fed ain't going to cut rates. Fed ain't cutting rates. Interest rates are headed higher. You know, believe what you want to believe. We're not going to cut interest rates. So invest accordingly. If you're a trader, it's appropriate as a trader to focus on the talking heads, the BLS numbers, because you can trade profitably around those events. If you are a long-term investor who is just trying to protect your wealth, focus on the big picture. Don't just ignore the talking heads. All they're blowing hot air. That's how they make money, is they're paid to bullshit you. That's how they make their money. Blowing hot air, getting you to believe and react to the bullshit that they are promulgating. You know, in my experience, trying to follow, if you are a long-term investor, trying to follow what they say in the short term is a very stressful way to live. And quite often, if you invest or deploy your long-term money based on what you are hearing from these talking heads with their, you know, their paid rhetoric, you'll lose money. You'll invest poorly because what they are saying is it's pure BS. This chart of silver, again, big move. Silver is not. I'm suppressing a sneeze. Silver is not as bullish as gold. I'll focus. Excuse me, didn't make it. I'll focus in a video. I'll focus on silver soon. Let's see, the dollar. Well, I want these two charts, the dollar and the 10-year note, yield on the 10-year note. Just want to show that gold is reacting to something other than weakness in the dollar. Dollar's not weak. Basically, the dollar's doing sideways consolidation. So strength in the gold is not being propelled by weakness in the dollar. And that's all I wanted to show here. Likewise, ooh, that's an ugly looking chart. Strength in gold is not being propelled by a pullback in interest rates. In my opinion, interest rates have pulled back again based on this output from the talking heads at the Fed. You know, and that's why we're seeing this pullback in interest rates, yield on the 10-year note. So, what else did we have? That's it for gold. I just want to give you a heads up, and I'll give you a link to this video in the description below this video that you're currently watching. This is an interview that the two Alexes, Alex Cristoforo and Alexander Mercouris, they are the principals of the Duran. Their channel is the Duran. This is Tom Luongo. Tom published an excellent article in the last, I think it was over the weekend. And then in this video, they are talking about his article. And so I just want to give you a heads up. This is 1 hour and 20 minutes. It's a long interview. it's well worth watching, in my opinion. This morning, I am on my second listening to this video, and I'm taking notes. And I'll share with you, this is where I'm at. And excuse me for being messy. I may or may not share my thoughts on this video in my own video. I can't do it justice. Certainly can't do it justice in a short video. Probably can't do Tom Luongo's work justice in a long video. So just go watch this interview by the Duran. And in my opinion, it's well worth your time. Some of the key ideas, he's suggesting that events in Europe at this point are occurring with the objective of creating a tax base for the euro. You think about the euro currency, it's a currency with no income. They have no taxing authority. They issued a round of bonds when the euro was launched, and the banks and entities that invested in those bonds, they're currently down at least 40%. So if you bought those initial euro bonds, you're down at least 40%. And so people are not very excited about buying more euro bonds, which puts the EU in an awkward spot. They're trying to issue EU bonds, new EU bonds, so that they have a future. I don't believe they do. In my opinion, the EU will go the way of the dodo. It'll take a while. But so anyway, they're trying to figure out how can we issue some new bonds. They've tried, climate change, the green movement. We had Christine Lagarde come out and say, we need to spend trillions of dollars on the green initiative. We need to spend trillions of dollars or we're all going to die because of climate change. Well, neither of those attempts have really caught on. Nobody's buying their bullshit. And so now they're trying a new story. We need war bonds. And so the EU needs to issue war bonds because of this great threat. Russia is directly threatening Europe, which of course, more bullshit. But so anyway, Tom Luongo is explaining in his opinion that's what the EU is up to currently. They're increasing their rhetoric about the risk that Russia supposedly represents in an effort to issue war bonds. What else? He emphasizes that Fed's not going to pivot. Fed's not going to go lower on interest rates. Oh, this caught my attention. The EU and the European nations at the peak had issued 14 trillion, again with a T, $14 trillion worth of debt instruments at negative interest rates, below zero interest rates. And here we are at 4+% across the duration curve. And so imagine that you're holding debt instruments that you paid negative interest. You paid a premium for the privilege of buying debt instruments that you knew you were going to lose money on. It's trading at a negative interest rate. You are guaranteed to lose money on that debt instrument. It's not an investment. It's let me set a match to these Benjamins or euros and just burn them up in the street. So, anyway, but $14 trillion worth of that kind of debt, a guaranteed loss on the money that you invested. Mind-boggling. The rest of the world uses the U.S. 10 and 2-year treasuries as their fixed point for setting their own reserve, their own interest rates. And and Thomas is suggesting, and I've got to think more about this idea, that the Fed is intentionally keeping interest rates high. And another reason that they're not going to pivot, not going to lower interest rates, is that they are intentionally trying to destroy the offshore market, the euro dollar and the euro bond markets. So anyway, I highly recommend this interview. So that's all I got in this video. Hope I've provided you with some value. Have a fantastic weekend. I'm going to continue settling into my new place, and I look forward to talking to you soon. So let me see here. Let me stop sharing my screen, and I will end this video.